Like price took support. Price is at 18,200. From here, price moved up. So when you see this red candle took support exactly at the 50 EMA. Hi friends, Chitra here. Welcome to my YouTube channel. In this video, we are going to see about the moving averages. Basically, what do you mean by moving average and why do we use moving average in our daily trading? Reading a chart without moving averages is like baking a cake without butter or eggs. So, a cake without butter or egg will not be tasty. Likewise, a chart without EMA, it will be very difficult for us to predict the direction of the market. Those simple lines above or below the current price may tell many tales and their uses in the interpretation. Simply stated, they are the most valuable indicators in the technical indicators. Also, many traders, they won't be using moving averages in their trading. You can trade without moving averages, but you do start it at your own risk. After all, these lines represent the median levels where your competition will make important buying or selling decisions. Near to the moving average is the place where you make an important buying or selling decisions. So it makes sense to predict what they are going to do before the fact rather than afterward. A moving indicator is a stock indicator that is commonly used in technical analysis, which helps to smooth out the price data by creating constantly updated average. That's why we have to use moving average in our chart. Moving average is a technical indicator that market analysts and investors also used. Why they are using? They are using to identify the direction of the trend. And why the name called as moving average? Why it is called moving average? Because it is continuously recalculated based on the latest price data. So each time, if you are using 5 minutes time frame, 15 minutes, 1 hour or daily time frame, accordingly the moving average will recalculate it based on the latest price data. So the name called moving average. Also, moving average is a technical indicator that investors and traders use to determine the direction of the securities. How it is calculated? It is calculated by adding up all the data points during a specific period and divide the sum by the number of time periods. Moving average helps technical traders to generate the trading signals. The most important EMAs are 5, 20, 50 and 200 EMA. 5 EMA we already know it is used for intraday traders and which marks the short term trend of the market. This will work best in the trending markets. If we are in a long trade, we can go along with the 5 EMA respectively for the short trade also. The 20-day moving average commonly works with the short term trend. 50 moving average is the intermediate trend which will measures the intermediate trend of the market. 200 EMA is the long term trend of the market. Now we can see about the 5, 20, 50 and 200 EMA. The longer the period of the moving average, the greater the lag. Means if we are taking 200 EMA in our chart, okay, and we have also 20 EMA. So 20 means if you are taking the daily chart. So 20 EMA, if the price is above the 20 EMA means in the shorter term the trend is a bullish trend, upward trend. If the price is below the 20 EMA in shorter term, that is for intraday traders, the trend is bearish. So if the price is above 200 EMA or below 200 EMA, that is for the long term trend. Like that only the EMA will works. A 200-day moving average will have much greater degree of lag than the 20-day moving average. Means the 200 EMA is greater period of average. It is calculating the more number of days. Okay, average, taking average from more number of candles. Okay, because it contains the prices of past 200 days. This past 200 days means they are considering the chart of daily time frame. According to the time frame which we are taking, like that the moving average we are calculating. 50-day and 20-day, 50 EMA and 20 moving average figures are widely followed by the investors and traders, are considered to be important trading signals. Moving averages generate false signals during the range bound markets. most of the indicators, they will work fine in the trending market, whether it can be uptrend and downtrend. In the range bound markets, they will generate the false signals because they are the trend following indicators that measures the upward or the downward momentum. They lose their power in environment that shows the slow rate of price change. So when we are in the range bound market and when we are taking trade with any indicators, possibilities are more to hit the stop loss when we are taking PE trade or CE trade, or when trading in stocks, when we are doing buying or selling, the possibilities are more to hit the stop loss on that day. It's harder for the price to break above the declining moving average than a rising moving average. Conversely, it's harder for the price to drop through a rising moving average than a declining. This is the Nifty 15 minutes time frame chart. Here the price is at 18,200 plus this zone. Okay, and after that price took support and price moved up. The high of the Nifty is 18,887. So without EMA, with this difficult for us to understand like price, where the price can take support and where the price can take the resistance level, where is the major support and the resistance level. So for that we will be adding moving averages according to the time frame which we are using or according to which type of trader we are. Now we can add the moving average. Go to indicators and moving average exponential. So by default it will be 9. So you can use any EMA. So here I am going to show the example with the 50 EMA. Okay. So as I told you before, like price took support. Price is at 18,200. From here price moved up. So when you see this red candle took support exactly at the 50 EMA. You can see that. Okay, price took support at the 50 EMA and from there the next day price gapped up and price moved up and made a high of 18,800 plus. And again when you see this green candle broke this 50 EMA and came low and made a low of 18,365. And from there we got this green candle and then price closed above the 50 EMA and price again moved up. Okay, so whenever you see the price is taking support at 50 EMA, from there the price is moving up, means price bounce up from here. Okay, so this is how you have to use the EMA in your chart or in EMA in your trading. So after the price touched the 18,800 plus, price came down and here this red candle broke the 50 EMA. Okay, and after the price broke the 50 EMA, till this much the price was in the consolidation zone. Here this is the price is in the consolidation zone. So this red candle again it broke the 50 EMA and after that price moved little bit down. After that again we can see there is a pullback to the EMA. Again this red candle broke the EMA, again price pulled back to the 50 EMA. Right? So whenever the price is away or price is far from the EMA, in that case price will always attract the EMAs. Now we can see where can we enter into the call and put trade, that is buy and the sell trade using the EMA. So this is a Nifty 5 minutes chart, or we can go for 15 minutes also. So here I will explain you in 5 minutes how can we enter into the trade. Here the price is moving continuously up. Okay, so many people what they will do, they will enter here, exactly here in the green candle. Okay, price is moving up, so why can't we enter into the long trade? So they will enter here, and what will happen when the price keeps falling, that this is called retracement. The small red candles, right, you can see here, these candles are called retracement. So what they will do, they will enter at right here. So they will enter at 18,093, and once the price reaches 18,766, they will think, okay, my stop loss got hit, and they will exit from the trade and they will book the loss. So where should we enter exactly when we are trading with the EMA? That I will tell you. So here the price is moving above the EMA. So here we got two dojis also. Okay, since this doji is very powerful, this doji, what does it means is it is an indecision candle, like fight between the buyers and the sellers, right? So when we are getting these types of dojis at the EMA or near to the EMA, it is very powerful. So above this green candle or above this doji candle is the place where we have to enter into the long trade. So once you enter into the long trade, this low of the candle will be your stop loss. So like this only you have to enter into the trade when we are using EMA in your chart. You should not enter here. If you are entering here, you should wait for the pullback. If you are not getting any pullback, don't enter into the trade. Avoid that types of trades. And I have already told you, when the price is far from the EMA, here there is much gap between the price and the EMA. In that case, what the price will do? Price will attract the EMA. So price came near to the EMA. So here you can look for buy. After this green candle, here you can look for the buy trade. Okay. So this is how you need to enter into the trade when you are trading using the EMAs. Now we can see how can enter into the PE trade. Till now I have explained you how to enter into the CE trade. So here you can see this red candle is below the 50 EMA. So here is the place where you have to enter into the short trade. Okay. So after this you can see that price is like falling down, right? Okay. And here we have a major support. This zone. Here we can see that there is a major support level here. Okay, because here also we have one support. So the same place Nifty took support here. So what majority of the people will do, price is falling, so they will try to enter at exactly at the support. We should not do that. When we are entering into the trade, according to the moving average, we should always look into the support and the resistance zone. So here what the price will do, because from here like 18,200, the price has fallen till 18,000. Okay, so almost 200 points Nifty has given a downfall. So after that, when you're trying to enter, you should be very careful. That too, you are entering at the support zone. So as I already told you, when the price is away from the EMA, in that case, what the price will do? Price will attract the EMA. So always try to enter near to the EMA when you are entering into the long or short trade. So again, after the price reached near to the EMA, what happened? Again, price reversed from there. We got a red candle. So here we can enter into the short trade. Also, you can see this red candle. This red candle also went near to the EMA and we got a inverted hammer here. You can see that. Okay, so like this, price will try to attract the EMA always. Again, after this, price started falling down. Here also there is a major support level. So at every support, the price, what it will do? Price will try to attract the EMA. Here, this zone is again the major support zone, right? So after touching this support zone, price again try to attract the EMA. Again, after that, we got the, after green candle, we got the red candle here. So here again, you can enter into the short trade. So this is how you need to analyze the price actions, analyze the candles with the EMA. This is the Nifty weekly chart. Here the price is above the 50 EMA. We got a dragonfly doji here. Okay. After that, price moved up. From here, the price moved up and gave a pullback to the 50 EMA, and again price moved up, gave a small pullback, and after that price moved up and gave a pullback to the 50 EMA. We should be very careful if you are entering near to the EMA. I mean, in that case, you should wait for the green candle if you are entering at exactly at the EMA. See what happens here. Price came near to the EMA and after that this red candle broke the EMA. So we have to wait for the green candle if you are entering into the long trade. Okay. Hope this video is useful to you. Please don't forget to like, share and subscribe. Click the bell icon too for my upcoming video notifications. Thank you for watching.